Introduction to the Intelligent Investor. The Intelligent Investor, first published in 1949 by Benjamin Graham, is widely regarded as the Bible of value investing. Warren Buffett, Graham's most famous student, has called it by far the best book about investing ever written. The book distinguishes between true investing, based on thorough analysis, safety of principle, and adequate returns, and speculation, which relies on market timing and short-term price movements. Graham emphasizes discipline, patience, and emotional control over high IQ or complex techniques. The most popular edition today includes commentary by financial journalist Jason Zweig, which updates Graham's 1973 text with modern examples while preserving the original principles. These principles remain timeless. Focus on intrinsic value, buy with a margin of safety, and ignore market mania. Graham categorizes investors into two types: defensive, passive investors seek minimal effort, diversification, and protection against loss. They aim for satisfactory returns through index-like portfolios. Enterprising, active investors, willing to devote time and research to find undervalued opportunities for potentially higher returns. The book has 20 chapters, blending theory, historical examples, and practical advice. Below is a detailed explanation, structured by key sections and chapters. Core concepts: investment versus speculation. Graham defines an investment as an operation which, upon thorough analysis, promises safety of principle and an adequate return. Anything else is speculation. Intelligent investors buy businesses via stocks, not ticker symbols. They focus on long-term business performance, not daily price quotes. Mr. Market allegory, introduced in Chapter 8. This is one of Graham's most famous metaphors. Imagine the stock market as a manic-depressive partner named Mr. Market who offers to buy or sell shares daily at wildly varying prices. Sometimes he's euphoric, high prices, sometimes depressed, low prices. The intelligent investor ignores Mr. Market's mood swings and only transacts when prices are favorable, buying low during pessimism and selling high during optimism. This teaches emotional discipline. Don't let market fluctuations dictate your actions. Let them create opportunities. Margin of safety. The central principle: always buy assets for less than their conservatively estimated intrinsic value. This margin protects against errors in analysis, bad luck, or market downturns. Like an engineer building a bridge to hold more weight than expected, investors should demand a discount, e.g., 30 to 50% below value, to buffer risks. Intrinsic value. A company's true worth based on earnings, dividends, assets, and growth prospects, not its current stock price. Graham warns against overpaying for growth, as forecasts are unreliable. Chapter-by-chapter breakdown. Introduction and early foundations. Graham sets expectations. Intelligent investing is achievable with discipline, not genius. He reviews market history to show stocks outperform bonds long-term, but with volatility. Chapter 1. Investment versus speculation. Results for intelligent investors are superior to speculators. Defensive investors can expect market average returns. Enterprising ones may outperform with effort. Chapter 2. The investor and inflation. Inflation erodes bond returns. Stocks historically hedge inflation better, but only if bought wisely. Chapter 3. A century of stock market history. Graham analyzes 1900 to 1970 data, showing stocks rise over decades despite crashes. Prices in 1972 were high, cautioning overvaluation. Chapter 4. General portfolio policy for the defensive investor. Recommend 25 to 75% stocks/bonds, rebalanced periodically, e.g., 50/50th default. Avoid timing. Use dollar-cost averaging. Chapter 5. The defensive investor and common stocks. Stocks for defense. Diversified, large/established companies with consistent dividends. Chapter 6. Portfolio policy for the enterprising investor, negative approach. What to avoid: day trading, IPOs, low-quality bonds, overpriced growth stocks. Chapter 7. Portfolio policy for the enterprising investor, positive approach. Seek undervalued securities, bargains in secondary companies, special situations, e.g., arbitrage, workouts. Chapter 8. The investor and market fluctuations, Buffett's favorite. Mr. Market explained in depth. Buy during pessimism, sell during optimism. Formula timing, buy low PE, sell high. Can work but requires discipline. Chapters 9 to 10. Investing in investment funds and advice. Critiques mutual funds, high fees. Prefers low-cost index funds. Prophetic, Buffett echoes this. Be wary of advisors. Chapter 11. Security analysis for the lay investor. General principles. Analyze financial statements, balance sheet, income statement. Chapter 12. Things to consider about per-share earnings. Beware accounting tricks. Use averaged earnings. Chapter 13. Comparison of 4 listed companies. Case studies contrasting good/bad investments. Chapter 14. Stock selection for the defensive investor. Criteria: adequate size, strong finances, earnings stability, dividend record, moderate P/E and P/B ratios. Chapter 15. Stock selection for the enterprising investor. More flexible. Seek undervalued stocks, low P/E, nets, trading below liquidation value, growth at reasonable price. Chapter 16. Convertible issues and warrants. Cautious view, often overpriced. Chapter 17. 4 extremely instructive case histories. Real examples of investment pitfalls. Chapter 18. 8 pairs of companies. Comparisons highlighting value traps versus opportunities. Chapter 19. Shareholders and managements. Investors should act as owners, demanding good governance. Chapter 20. Margin of safety as the central concept. The book's climax. All intelligent investing revolves around buying with a sufficient discount to intrinsic value. Concludes that satisfactory results are easier than superior ones. Postscript and appendices. Graham reflects on changes. Modern editions include Buffett's insights. Key strategies for investors. Defensive portfolio, broad index funds, or blue chip stocks plus bonds. Rebalance mechanically. Enterprising approach. Hunt for bargains using quantitative screens, e.g., P/E less than 15, debt low, dividends paid. Avoid hot stocks, day trading, over-reliance on forecasts, high fees. Psychological edge. The biggest enemy is yourself, greed and fear. Stay rational. Modern relevance, from Zweig's commentary. Zweig updates examples. .com bubble parallels 1970s Nifty 50. 2008 crisis shows margin of safety's value. Index funds, praised by Graham indirectly, dominate today. Behavioral finance validates Graham's warnings about emotions. In today's tech-driven markets, principles like avoiding hype, e.g., meme stocks, remain crucial. Why read or apply this book? As a content creator, you can use these ideas for videos/scripts on value investing, Buffett stories, or market psychology. Graham proves that ordinary people can invest intelligently without Wall Street's tools. The book isn't about getting rich quick. It's about preserving and growing wealth steadily, avoiding ruin.